Hi everyone, it's Stephen here. I've spent the last decade looking for the best cash flow investment properties to buy, and I can safely say I now know what investment properties to buy for cash flow. At a time when we're seeing house prices right now at an all-time high, we're seeing inflation rates at the highest levels in 3 decades. Petrol prices have hit record highs too, and we've been bombarded every day with concerns over rising energy prices well before the impact of the Ukraine war, and now I'm hearing milk is set to go up by a third. So buying properties that cash flow, that put money in your pocket each month, is now more important than ever if you want to beat inflation, rising petrol prices, and accepting you may have to drop a tenner on a takeaway coffee. So I'll talk about what investment properties to buy for cash flow, which ones to choose to outperform inflation, which investment properties will cost you nothing out of pocket for years, and which ones can be truly passive. To achieve the maximum cash flow of an investment property, your goal as an investor is to get the gross rent that you receive to be as close as possible to the net rent that you get to keep. Remember, gross is what you make and net is what you get to keep. So what type of property gives you this outcome? The answer is a fully tenanted commercial property with a full repairing and insuring lease in place. Now we want it fully tenanted because commercial properties are made up of all sorts of different bits and pieces. So it could be an office, it could be retail, there could be upper parts to it, there could be a warehouse connected to it. So all these different parts that may be available for rent, we want them all fully tenanted. And a full repairing and insuring lease, or FRI for short, means that all maintenance, repairs, insurance are going to be paid for by the tenant. A schedule of condition is typically written up with an FRI lease, so this keeps like a baseline of what the condition is of that property when the tenant moved into it. And therefore, when it comes to a point when they vacate down the road, they have to maintain that property to that same condition that it was when they went into it. A lot of you may be thinking, why not residential? For example, HMOs or service accommodation, you can get great returns with those. These are okay, but the trouble that I have with those is that they leave you as the landlord, the investor, on the hook for all of the costs associated with those properties. So if there's a leaking toilet, failed appliances, leaky roof, needs painting, anything that you can think of that can possibly go wrong with that property, you're on the hook for it. Anything that's inside it, furniture, fixtures, all of those things, if you're doing service accommodation, you're on the hook for it, you're on the hook for the insurance. So all of these things are coming out of your pocket, not the tenant's pocket. All of these costs eat into your cash flow and erode your net rental income. So let's have a look at some examples to explain this better. So with residential property, we've got our income and our expenses. On our income side, we've got the rent that we're generating every month. On the expenses side, we've got maintenance and repairs, so faulty appliances, leaky taps, leaky toilets, that kind of thing. We've also got ground rents and service charges if we've got a leasehold property. We've also got insurance, so that could be buildings insurance, landlord insurance. You may have property management expenses, letting out that property, leases, collecting rent, those types of costs, advertising. You're going to need health and safety certificates, so a gas safety certificate, an EPC certificate. You're going to also be on the hook for water, gas and electricity when there's some vacancy periods, or if you're doing serviced accommodation, you've got to factor that into your price. With service accommodation, again, you're going to be on the hook for all the furniture, appliances. That maybe also you want to ensure that, the contents of that property. So all of those things add up, unfortunately, and the total of all of those expenses gets taken off from your gross rent, and that equals your net rent. And it's eroding your gross rent each month because these things fluctuate and there's going to be a fixed amount for some of these things that you just can't get away from. Then if we look at a commercial investment property, we have on the income side the rent, and then on the expenses side, nothing. And this is because all the expenses are paid for by the tenant. This is written up in a full repairing and insuring lease. So they're responsible for the business rates on that commercial property, they're responsible for buildings insurance, they're responsible for the maintenance and repairs on that property as well. So this means then that the gross rent equals the net rent when we're looking at commercial properties that are fully tenanted with a full repairing and insuring lease in place. And the big bonus with commercial properties is that the rent is usually paid quarterly in advance, which is also great for cash flow. On top of these expenses, we also need to think about vacancy rates. Now, residential and commercial properties have vacancies. With residential properties, these are going to occur more often, but tend to be shorter. So they could occur every 6 to 12 months, but probably allow for 3 to 4 weeks that you might have a vacancy period. With commercial, they're going to be less often because you can have long leases with commercial property, and they can range from 1 year to 3 years to 5 years, even up to 20 years long. So therefore, you've not got a vacancy for all of that period in time. There may be break clauses in there, but we're just keeping it simple and going for the full length of that lease. But with commercial properties, when you do have a vacancy, it's likely to be longer than that 3 or 4 week period with residential. So you need to kind of factor that in when you're looking at cash flow, because you need to have that period of time where you've got some cash available for paying for some of the things that the tenant would normally pay for, because you're now on the hook for those. But you might have to be only on the hook for those every 5 years, and that might be for 6 months or something. So that's something you need to weigh up when you're looking at commercial properties. At the end of the day, we're not investing in properties to get a job as a property manager. We're doing it to generate another income stream. So we want something that's going to be as passive as possible, and commercial property is truly passive if you've got a tenant on a full repairing and insuring lease that's paying quarterly in advance. You don't need to employ a property manager when you've got commercial investment properties set up like that. All you need to do is send quarterly invoices out and check that the money has been paid into your bank. To beat high inflation, there's little point in holding on to cash because its value is dropping over time. The 12-month inflation rate in February was 6.2% in the UK. So I want my cash invested in property that's going to be beating this 6.2% rate of return. Otherwise, I'm going backwards. To help you do this, you need to watch this video on how to find good commercial investment property deals that will deliver 10% or better returns. Thanks so much for watching. I really do appreciate it, and I'll see you next time.